Hi, Jonathan York, Bay Financial Partners, looking at the investment markets. It looks like the US government shutdown is close to ending. There's been a sort of bipartisan bill that has passed the Senate, is now up before the House. Now, this is the longest shutdown in US history. It's over 40 days now. Not that it appears to be sort of worrying Trump too much. He seems to be just carrying on doing what he wants. Even raising a few questions among his sort of support base after he hosted another lavish party at the weekend. Now, obviously, the Republicans are still reeling after the results of the elections last week, where really it pretty much was a clean sweep for the Democratic Party. And most of that sort of comes from the sort of incorrect statements that seem to be coming out of the administration, mainly to do with inflation. Trump and the administration claim there is no inflation. They inherited very high inflation from the Biden administration, but that is now disappeared from the economy. Well, official figures still show inflation running at around 3% in the US, which is still 1% above the Fed's target of 2%. Because prices are starting to rise here as a result of tariffs. Now, with the Fed meeting again in December, it's just going to be interesting to see what transpires at that meeting because, certainly the US economy is still very weak out there. But obviously with the shutdown, there's no data coming through. But some of the private companies have sort of come out and estimated that potentially for October, the US economy lost around 150,000 jobs. So really not the hottest economy that Trump is trying to sort of convey out there to the public and the global media. And certainly if the government shutdown does end now, it'll be very interesting to see that employment data coming through in December. Because that looks like it will be a very weak number. So US rates, after the recent Fed cut, have actually nudged up. The 10-year is well above 4% now at 4.12. The 2-year is 3.62. And the 30-year is 4.70. So does that give a little bit of an indication of which way the market thinks that interest rates are going to go? Because although you've got a weaker sort of employment scenario, you've still got rising inflation out there, and it's certainly not under control. Now, oil back above $60 a barrel now at $61 and change. Now in the UK, it really does seem sort of a long, slow grind until we see the budget out there. It's certainly going to be very interesting to see what sort of taxes are increased to try and get that funding under control. But that's against a backdrop of, again, of a pretty weak economy. You've got rising unemployment, but also as well, you've got the inflation that appears to be sort of nudging up as well. And that's hampering the Bank of England's ability to be able to cut rates. Now the EU region seems to be in a bit of a holding pattern, really, sort of waiting to see what happens with the potential sort of tariffs from the US and the impact on their economy, but also as well waiting to see what happens with the sort of Russia-Ukraine conflict as well. because certainly Putin is showing no signs of wanting to end that war. Now in Australia, that recent CPI print at 3% really has sort of hampered the RBA's ability to be able to cut rates. They were certainly hoping for a print that had a two handle, and that would have given the ability for them to be able to cut rates before Christmas. But if inflation remains around that 3% level, it may be pretty difficult, and some economists and analysts are even sort of saying that potentially we've seen the end of the easing cycle in Australia. Now here in New Zealand, as expected, unemployment was up 5.3 in the September quarter. That was no real surprise. It was anticipated to sort of peak at around those sort of levels. But looking at it now, there are some reasonably good signs that the economy is starting to turn around. You're seeing quite a few more job ads coming through. But also as well, the jobs filled data is also improving as well. Now that added to the improvement in the housing market. Indeed, recent data again shows a record number of first home buyers coming through in the housing market. Now that's obviously all being helped by the recent cuts in the OCR, and potentially we've got a further cut at the end of this month. Now if that is the case, that will take the OCR down to 2.25%, which is a full 1% below where the sort of bottom was expected to be at the beginning of the year. So now obviously as you head into the sort of all-important summer and holiday period, it's just going to be interesting to see how the economy does sort of tick along. Because the hope will be that tourism certainly picks up, and that will then spread out through the regions and really see a little bit of growth coming through in the New Zealand economy. But for the New Zealand equity market as well, that's doing reasonably well because, you know, a lot of the sort of investors out there who had been investing in sort of term deposits, their rates are obviously falling with the interest rate cuts and are now below sort of 3% on a net 1 year term deposit. And so with those lower returns, they're now starting to look at the dividend streams on New Zealand equities. And some of those look pretty attractive. So if you are looking for income options, go to the website www.bayfinancialpartners.co.nz for lots of interesting articles, and we'll look forward to speaking to you soon.